If we look at life insurance from a broader perspective, there are two major types out there. One is temporary life insurance, also known as term insurance, and the other one is permanent life insurance. Well, I have made a separate video which talks about why we need life insurance and how term insurance works. In this video, let's understand more about permanent life insurance and how that works. Hey there, welcome back. You are with me on Be a Moon, Not a Star. In a nutshell, term insurance can be purchased for a specific period of time. Based on your needs and goal, you can buy the term insurance for 10 years, 20 years, or 30 years. And of course, term insurance has a lot of advantages. And one in specific, the premium is very low compared to any other life insurance. At the same time, term insurance also has some cons. If you are able to understand the cons the term insurance has, then we can very well relate why we need permanent life insurance. To understand the cons the term insurance has, let me share with you an instance. I purchased my term insurance a couple of years ago when I was 33. Based on my needs and goals, I decided to go with 30 years term insurance. I have been paying around $90 for a $1 million death benefit. A quick reminder, term insurance has just one component in it. That is called death benefit. That says, if anything happens to me during that set period of 30 years, my beneficiary will receive the death benefit of 1 million. Now, let's understand the term insurance in a different perspective. Once I turn into 63, I have to make a decision whether I am going to renew my term insurance or not. If I decide to go with renewal, there might be two possibilities could happen. One is some term insurance may not be renewable after a certain age. If I fall into that category, then I need to purchase a new term insurance. I want to emphasize that the life insurance premium depends on few factors. One is your age, second one is your health condition. If you look at my example, I purchased my term insurance at age 33. That time my health condition was much better. If I want to do a renewal at age 63, or if I want to purchase a new term insurance at age 63, my health condition is not going to be the same when I purchased my term insurance at age 33. That has been said, my term insurance premium is going to be high when I do a renewal at age 63. That's where the permanent life insurance comes in place. To begin with, permanent life insurance offers lifetime coverage. Doesn't matter whether you are 90 years old or 100 years old. Well, if you look at permanent life insurance, there are three major types out there. One is whole life insurance, second one is universal life insurance, and the third one is index universal life insurance. I purchased my permanent life insurance a couple of months ago and I decided to go with IUL, Index Universal Life Insurance. From my perspective, Index Universal Life Insurance stands out than any other permanent life insurance. I am planning to make a separate video to talk about IUL, Index Universal Life Insurance, how that works. In this video, let's stick with how permanent life insurance works in general. If you look at term insurance, which has just one component in it, that is called death benefit. And on the other side, if you see the permanent life insurance, which has more than one components. The first component is living benefit, also known as cash value accumulation. And the second component is death benefit. In addition to these two components, the permanent life insurance also offers investment growth. Let's see how those works in detail. To illustrate this further, Let's consider my term insurance and my permanent life insurance. A quick reminder, I purchased my term insurance a few years ago. I've been paying $90 per month for a $1 million death benefit, and the term period is 30 years. On the flip side, I purchased my permanent life insurance a few months ago. The initial face value is 500k, which means the initial death benefit is 500k. The premium that I've been paying for my permanent life insurance is around $400. Now you can see the difference. For the term insurance, I'm paying $90, and my permanent life insurance, I'm paying around $400. Now let's understand how the permanent life insurance and the term insurance works. As I mentioned earlier, term insurance has just one component in it. So whatever the $90 premium that I pay, go to my death benefit account. It's a straightforward one. But if you look at permanent life insurance, as I mentioned, the permanent life insurance has two components. One is cash value accumulation, also known as living benefits account, and the other one is death benefit account. Well, what happens to that premium that I pay? In my scenario, $400 I have been paying. That monthly premium will be moved to two different accounts. One is my cash value accumulation account, and the other one is death benefit account. I also want to let you know that in the first few years, the majority of the premium will be deposited into your death benefit account. A very little will be deposited to your cash value accumulation account. So what happens with the money that sits in the cash value accumulation account? Well, insurance company will take the money to invest somewhere. It might be in stock market or it might be in any business venture. Whatever interest that you get will be deposited back to your cash value accumulation account. That's how the cash value accumulation account grows slowly. And if you look at your cash value accumulation account over the period of time, you are going to have a lump sum. Now let's understand why we call the cash value accumulation account as a living benefit account. Let me share with you an instance. If I look at my living benefit account or the cash value accumulation account 10 years down the line, the account may have $30 or $40 or $50,000. Well, I can access that money at any point. For example, if I need $30 or $40,000 for my kids' higher education, or if I need the same $30 or $40,000 to do any house repair, then I can access my cash value accumulation account to take the money. There are two ways you can access your cash value accumulation account. One is a smart way and other one is a dumb way. The smart way is not to withdraw your money. Rather, you can take a loan against your cash value accumulation account. The dumb way is to withdraw the money from your cash value accumulation account. Why we call that as a dumb way? If you withdraw your money from your cash value accumulation account, then you have to pay tax for that. Here is a kicker. It's not required that you need to pay off your loan. How that works? When the policyholder passes away, the beneficiary will receive the death benefit. In my case, the death benefit is 500k. At the same time, I also bought a loan against my cash value accumulation account. That is $40,000. So the 500 as a death benefit minus $40,000 as a loan. So my beneficiary will receive the remaining 460k as a death benefit. That's how the cash value accumulation account works. Now it's a time to understand how investment growth works in your permanent life insurance. If you look at the cash value accumulation account, as I mentioned earlier, whatever money sits in your cash value accumulation account will be invested into stock market or any other investment vehicle. And whatever interest that we get will be deposited back to your cash value accumulation account. And if you look at your cash value accumulation account over the period of time, you can see the lump sum amount. That's how the compounding effect also works. So that is the reason the permanent life insurance also has another benefit is called investment growth. Let me summarize this real quick. If you look at the term insurance has just one component. That is also one of the reasons why we pay less premium. And the other side, if you look at the permanent life insurance, which offers lifetime coverage. In addition to that, it also has other components in it. One is living benefit, also known as cash value accumulation, and the second one is death benefit. And above all, you are also going to have investment growth if you buy a permanent life insurance. In the upcoming video, I'm going to talk about why index universal life insurance stands out than whole life insurance and universal life insurance. Stay tuned. If you find this video added any value to you, do me a favor. Click the like button and subscribe to my channel BMO Nada Star. We'll see you there in another video a week from now. Until then, I am Prakash.